Meet Kate. She's 28, works in operations, and commits to a strict habit, putting $300 a month into a broad market index fund. She follows this plan without fail, month after month. Fast forward exactly 10 years. By age 38, she has sacrificed $36,000 of her own paychecks to feed this account. After a full decade of discipline, she opens her statement to find that the market has generated roughly $16,000 in total gains. That $16,000 feels small against the weight of 10 years. In year 10, her annual market return is still roughly $3,400, actually less than the $3,600 she contributed from her own salary this year. To make matters worse, she's surrounded by the noise of a friend group chasing tech stocks or crypto, leaving her feeling like she played it too safe for a trajectory that barely seems to move. 10 years of discipline has produced a balance that still looks small. This is the point where the visual inertia of a flat curve often overrides the commitment to stay invested. Most expect saving to build wealth in a steady ramp, a straight diagonal line, where effort equals results. But actual compounding stays agonizingly flat underneath those expectations for the first 10 years. That massive empty space is where doubt replaces discipline. The frustration comes from a simple mathematical reality. Compound growth doesn't run on your monthly contribution rate. It runs strictly on the total account balance. Surviving this flat line requires ignoring the calendar and instead tracking your progress against 3 specific mathematical thresholds. The first threshold is the starter floor, covering any balance under $50,000. On a $30,000 balance, a 7% return yields about $2,100 a year. Notice the taller column representing her $3,600 paycheck contribution. At this stage, her labor is doing more work than her capital. This stage feels exhausting because 7% of a small balance is a small number. The compounding is happening, but it's essentially invisible against the size of the monthly deposits. Then the account enters the inflection band between $50,000 and $100,000. At a $75,000 balance, a 7% real return yields $5,250 annually. This is the crossover. For the first time, the market is injecting more money into the account than Kate is putting in herself. Reaching this crossover means the account has finally woken up, marking the permanent transition from active saving to passive compounding. The final threshold is the catch fire stage, which begins once the balance crosses $250,000. Look at the difference in scale. The tiny dot on the left is the $119 the market gave Kate in year 1. The towering block on the right is her year 30 market gain, $24,400. Year 30 alone delivers more growth than the entire first decade of her saving life combined, even though her monthly contribution never changed. This explosion happens because the percentage finally has a massive base of dollars to multiply against, eventually making her personal contributions feel like statistical noise. This staggering late-stage acceleration proves large balances always generate faster growth than consistent small contributions can. Several variables can sabotage this velocity. The very first disruptor is the use of high-fee, actively managed funds. This graph shows Kate's final 30-year curve. A seemingly small 1% annual expense ratio shaves $65,000 off her final balance, effectively slicing the top 20% off her peak growth. These fees physically push the catch-fire threshold further down the timeline, often delaying the exponential curve until after a working career is over. The second disruptor is attempting to replace lost time with larger amounts of money. Many savers wait until their 40s to start, hoping aggressive contributions will compensate for the delay. Doubling your contributions at age 43 fails to catch up to starting with half as much at age 28. The late start deprives the math of the decades it needs to multiply. Time in the market is the one variable that money cannot buy out of. A delayed start permanently neutralizes the final vertical curve. Interpreting the slow, grinding first decade as evidence of failure leads many savers to fold just as the math begins to accelerate. Instead of obsessing over 3-year projections, locate exactly which rung of the ladder you sit on today. Track the ratio between your annual market gain and your annual contribution. When the market begins matching your paycheck, you'll know the momentum has shifted. Next, audit your investment fees immediately. Small costs are the primary reason the catch-fire date moves further out of reach. That decade of invisible progress represents the mathematical price of admission required to reach the vertical part of the curve.